Hey there, this is Simon, personal finance coach. This video is about exploring the role of bonds in your investment portfolio since bond yields are on the rise and AAA corporate bond recently passed 5.1%. Investors that do not own bonds but care about income generation or diversification from stock market or preservation of capital or portfolio stability or all of the above, this might be a good time to lock down high-yield bonds as rates haven't been this high since 2011 and they will likely go down in the future. If you buy a 5, 10, or 20-year bond, it will remain in your portfolio for years, producing a continuous 5% yield. Investors that are used to the stock market and have not invested in bonds, it's worth to highlight that the bond market is bigger than the stock market and the average bond fund return in 2023 was 6.2%. In the interim, please subscribe to this channel to get notifications on new videos. So why bond yields are on the rise? Usually, several factors are affecting bond yields. First factor is interest rates. When Federal Reserve Bank raises interest rates, newly issued bonds pay higher interest rates, increasing the yield on existing bonds while causing the bond prices to fall. Second factor is inflation. If inflation is expected to rise, yields go up while bond prices tend to fall as well. This is because the fixed interest payments from bonds become less valuable in real terms. The third factor is economic conditions. If economy is expected to slow down, yields go up while bond prices fall due to perceived risk attached to bonds. And fourth factor is supply and demand, the driving force of free market economy. Oversupply or low demand causes yields to go up and bond prices to go down. Given all the four factors of interest rates, inflation, economic conditions, and supply, the interest rates have risen to these historical high levels. The biggest three main reasons for increase in yields today is inflation, government, and strong stock market. Government is issuing supply of new bonds to cover debt with higher yields to attract new lenders. A strong stock market is also contributing to rise in yields because bonds are competing with an attractive equity market which pushes rates higher. While some economists remain concerned about a near-term recession, high government debt and inflationary concerns are likely to remain for some time and keep bond yields elevated. In summary, for bond investors, it is a good time to buy new bond assets and hold the ones they already have. Investors that do not own bonds but appreciate steady income, diversification, and portfolio stability, this is a good time to lock down some high-yield bonds. Investors who currently do own bonds, now it's probably a good time to sit still. Unless you have a strong reason to do so, it may be wise not to sell right now and wait for the market to cycle back around. Please subscribe to this channel to get notifications on new videos, and thank you for watching.